So for a moment I was gone a little bit, but let's go on. So we were saying that Mary buys one standard lot, a notional amount of 100,000 USD of USD JPY at a rate of 79.5, and we've been referred to a figure. This one's figure one. This is it. So she buys it at this part. So let's go on. So we see she buy at 100,000 USD at 79.50 USD JPY. That converts to 7.95 million JPY. Okay, paid on buy. So let's go back and see if we understand that. So to control that position, Mary needs to post margin from the USD 10,000 of available funds. So we had first seen that Mary had 10,000 in her account. So with 50 to 1 leverage, oh, that's the ratio of which she's leveraging at. Mary need only pledge 2,000 as margin on a 100,000 USD position. So let's see if we can see what that means in calculation. I have not written anything yet, so just a moment. Let me place the camera well. Okay, so leveraging and margins. Yep. So Mary has 10,000 USD and she wants to leverage. She leverages at 50 to 1 ratio for a standard lot. And as before, we had seen that a standard lot is 100,000 units of the base currency, which in our case here is the USD. So 100,000 USD. So she's leveraging at a ratio of 50 to 1. So now let's see how much she needs. So you'll say that if 50 is 1, if 50, this is just basic maths. If 50 is 100,000, how much will she need for one unit? Because that's what she is leveraging at. That's the ratio that she'll be using. So how much will she need to represent this 100,000 units? So she'll need 1/50 of that 100,000, which is in our case $2,000. So she'll use $2,000 USD for a position. So she'll use 2,000 USD for a position of 100,000. So with 50 to 1 leverage, Mary need only pledge 2,000 USD as margin on a USD 100,000 position. So she'll use 2,000 as a margin on a 100,000 USD position. So she'll only spend 2,000 of the 10,000 she had to trade with a position of $100,000. I hope that's clear. Moreover, since there is 8,000 US dollars of unpledged funds, she had 10,000 of us, so she has 8,000 more, which is unpledged. Mary has room to take an even larger position if she so desires. Yeah, so now we've understood the part of leveraging and margin. Let's assume Mary is correct. She bought, right? And when you buy, you expect it to go. You expect the base to go up, while here our base is the USD and our quote is the JPY. So she expects the base to go higher and the JPY to go lower. Let's assume Mary is correct, and the USD JPY price moves higher from 79.50 to 80.00. So at 80.00, Mary is content with her gain and she takes her profit by selling an equal one standard lot of USD JPY. So she now sells it after being content. She predicted that at 79.50 it would go higher, and now it has reached 80.00, and now she's content. So now she sells it, and she takes her profit by selling an equal one standard lot. You remember she held a one standard lot position, so now she sells an equal one standard lot at this price, 80.00. So now let's look at how leverage helped her. Okay, so this figure 1 we had gone through this, and this figure 2 now we are going through this. This is the figure 1 that we had gone through. Let me just zoom. Yeah, that's figure 1, and now this is figure 2. Yeah, so now at 100 for the leverage that she had, remember she only used 2,000 for this to hold a position of one lot, which was 100,000. Therefore she, at 79.50, we can say that she paid 7.95 million Japanese yen. And then at selling that one standard lot position at 80 USD/JPY, she sold it at 8 million. Thereby, if you take that difference, 8 million and 7.95 million, you find that she made a profit of 50,000 JPY. That was her profit. But now this is in Japanese yen. So now, since Mary's FXDD account is in USD, JPY profit needs to be converted into USD at the current USD JPY exchange rate, which in this example for our case it's 80, because now she's selling it at 80. The profit is at 80, right? When she sold it, that's when now we are calculating the profits. So she needs to exchange it back to US dollars from Japanese yen, and therefore her profit from Japanese yen, 50,000, would equal, so you take the profit, then you divide by the exchange rate, which in our case is 50,000 Japanese yen divided by 80.00 Japanese USD exchange rate. So by doing that, let me just get my calculator. Yeah, and then now from my calculator, 123 divided by 80, that gives you 625. So profit of, let's write that down. So profit of 123 JPY at sell of 80.00 gives 625 USD profit. Let me just write profit. Yep. So just by that, so I could also write here just for memory, about 79.50 sold 80.00 profit on standard lot would be 50,000 JPY, which is 620. Okay, let me just 625 USD. Yeah, that's quite understood now. So moving on downwards, the return on investment gives a trader an idea of how much they made or lost. So this is the return on investment. Oh, apologies for that. The ROI, return on investment, or margin, gives a trader an idea of how much they made or lost a trader in terms of the ROI or margin applied. In our example, we know Mary played 2,000 of margin to her USD trade and made profit of $625. To calculate her return on investment, divide the profit by the margin. So her return, okay, so her margin was 2,000 and she got a return which is a profit of $625. So dividing that, the profit by the margin, we'll get that she had a return on investment of 31.25. So let me just write that down. ROI is equal to profit slash margin. So in our case, that is 625 over 2000, which is 31.25%. So we'd say that this 2000 here is the margin. Let me use a different pen. Is the margin. Yep, that way. Moving on to the next thing. Let's see. Calculate her ROI. Divide the profit by the margin. Okay, that's good. Okay, just something else that's important here. Let me just enlarge that and show you this part. So let's keep in mind that if the market was to move against Mary's position, she would have lost funds. For example, if Mary bought one standard lot and the price moved 50 points in the opposite direction from 79.5 to 79, she would have lost $632.91. So we can just do simple calculation of that and see if we got it right. So it means that if the markets were to move against her, then with the standard lot at 79.50, a standard lot she would have invested 7.95 million. Okay, 7.95 million JPY. Then if it moved 50 points down in the opposite direction, then that means that she would have sold it at 7.9 million. 1, 2, 3, making a loss of 50. 1, 2, 3, making a loss of 50,000 JPY. So if she made a loss of 50,000 JPY, then her take profit in USD, a take loss, I don't know whether it will be a take loss. So her loss in USD, let's put this to be a negative to make the difference that it's a loss. So this is negative 50,000. So her loss will use the now existing form will now use the now existing position to calculate her loss in USD. So that will be, she'll be selling it at 79.0. So we'll take negative 50,000 divided by 79, and then we'll find that taking that 5123 divided by 79.00, we get 632.91 USD. She'll had made that loss 632.91 USD. So that being understood, we can go on to the next bit of it. So having done that, we now have understood leveraging and margins. So let's move to the technical analysis bit. Because the forex market moves so quickly and aggressively, currency pairs are said to be highly trending, with the pairs value often following a pattern of growth or decline. So since it moves aggressively and quickly, it follows some patterns, and they are said to be, and the patterns can be followed and traded. With so many trades going on every day, it's possible to utilize common analytical tools to detect patterns and make predictions. And this is what many people do when they want to do forex for speculation. So technical analysis attempts to predict future price movements by analyzing past price patterns and mathematical indicators. Price charts are the primary platforms used by technical analysts. Price charts. These exchange rates charts show historical price patterns that can be used to help predict possible price events in the future. Some key technical analysis tools and techniques include trends. So there are trends, these are the trends. And then now let's move on to the second bit. The concept of trend refers to a net price movement over time, either to the upside or to the downside. Currencies tend to trend. Apologies for currencies tend to trend frequently and for fairly prolonged periods of time. Trading with a trend is often advocated because in doing so, the trader is trading with the general net flow of the market. So using this trend, you can predict what happens next. And this is highly encouraged because traders can easily know how the market will go. Support and resistance. Support and resistance represent important characteristics of all financial markets. Support can be considered price floor, while resistance represents a price ceiling. So support, let's see here. Support is this price floor, and resistance is this ceiling. So we at different points we have the support and resistance. Then here we have the breakout. Support and resistance exist because of market memory. Market participants remember certain past price levels or regions where prices stand, and they then act upon these levels in their trading. One can therefore predict enhanced trading activity when prices reach these levels. Support and resistance levels can be used whether traders are trading breakouts of these levels or bounces. So at this point we can see that the market moved in this manner. It had a support at this point and a breakout at this point and a resistance at this point. So whenever it reached this level, it resisted and moved back down. And then when it hit the support level, it then moved up. So someone can really predict that when at a point a currency is at this point, he or she can predict that when it reaches at this point, she can then buy for it to rise to that certain level. And this helps traders make profits easily. So by knowing where the supports and resistances are, you can know whether to buy or sell. And by knowing that also, you can know whether a currency pair has breaked out of that pattern. Like this point, that's a breakout point. So it has left the trend that was happening here. And moving on to the chart patterns. Chart patterns track price action across time. These patterns can provide key clues as to future potential price movement. So there are different price patterns. Here we can see there's this symmetrical, ascending, descending. Okay, so I see important chart patterns include triangles, flags, pennants, rectangles, wedges, head and shoulders, and double and triple tops and bottoms. Usually a trade entry on a chart pattern is triggered on a breakout of that pattern. It is triggered on a breakout of this pattern. So that's when a trade entry on a chart pattern is triggered. So just to understand this, let me see if, not discussed down below, but generally what I see here is this. You can see these triangle patterns, these types of triangle patterns, there is ascending. So let me just write it down and try showing you. So here we have triangle patterns. So we'll do this. So there's this one that moves like that. Let's say that one. So if we draw a line below it like this, and then we draw another line downward like that, You see, this is symmetric. This side and this side looks almost similar. That's symmetric. Like it forms such a triangle as this. So that one we call symmetrical. Symmetrical. And then let's look at this one. So there's another that moves in this manner. Let's say such a manner. So if you draw a line here and then you draw another line here, you see this one is moving to the top. Let me add here, moving to top. So we can call this one ascending. Anything ascending is anything moving upwards, like Jesus' ascension. Yeah. So then the third pattern, we have this one here. Yep. Let's just move it like that. And then now that one, if you draw a line below and then you draw another from here touching the tops, then you will see that this is moving in this manner downwards. So moving downwards, and that's descending. Yeah. Moving on. And now moving on. By the way, I watched Dylan Page. I'd like to get the aura too. Okay, so moving on. Moving averages. So moving averages are running averages of past price action over a predetermined period of time. These indicators smooth out often choppy price actions and can provide useful indications as to price trends and trend changes. So I think, okay, let's see that. Ask bid. We'll need to do further research on that. These are just highlighted. I guess this book is ending on page 20, and then the rest 5 pages are just questions. I think now they're just highlighting, but we'll need to look for another book to go through this part of important chart patterns, flags, pennant, triangles, rectangles, wedges, head and shoulder, and double and triple tops and bottoms. Okay. Moving on. Moving averages are running averages of past price action over a predetermined period of time. These indicators smooth out often choppy price action and can provide useful indications as to price trends and trend changes. So indicators, and okay, here actually I think I can figure out something. So you can see this line, this continuous line, this one here. I think that's the moving averages. So now, like, this guy has made a smooth curve cutting through the prices just to see how the prices move, the averages, how the prices move generally. Yeah, so that's the moving averages. You can use that to know whether when it reaches this point, will it go down or will it continue going up. If you look at it for a longer period of time, you can know where it will be going. So indicators and oscillators. Most of these indicators and oscillators provide indications of possibly overbought and oversold price conditions, as well as trend determination and trading signals. There are many mathematical indicators and oscillators that can be overlaid on a price chart. ADX indicators. So that's one example. ADX indicator. We need another book for that. I'll look for a book and then recommend it for us. Indicators and oscillators, accumulation/distribution volume. Okay. We just need to see what they look like. This like a prerequisite now. And then RSI overbought/sold. Oh, this was accumulation/distribution. Then this one is overbought/sold. sold. So here we can see this indicator shows the buyer's territory and the seller's territory. So above 50%, above 50, below 50, you can see most people are buying at this point, at around that point. Yeah, and most people sold at these levels. When it passed these marks, then most people sold them. We'll continue looking at that in the next class, in the next video. Fibonacci. Let's see Fibonacci. The Fibonacci sequence is a mathematical construct based on historical mathematical observations that have been adapted to financial market trading. I've had Fibonacci in one of my classes. I do mechanical engineering. So in one of the classes, one of my mathematics classes, I've heard of Fibonacci, and I'll tell you what it is in our next class. So here, Fibonacci trading is based on the golden mean and provides trading ratios that can be used in determining potential target price levels and possible price turning points. Let's increase that, or I'll dedicate one video for Fibonacci, and then we'll understand Fibonacci curves perfectly, then we'll relate it to trading, and then we'll continue with the other videos. I'll sure do that before